Let me get the PowerPoint up and going here. Okay, I think everybody can see that now. Welcome. I'm glad everybody can attend. We are going to be looking at 4 areas tonight. Record keeping, the food program, contracts and policies, money management, and retirement. As was indicated by Andrea, I'm happy to answer questions during the webinar. Please go ahead and post them. But if you have questions afterwards, I'm also happy to answer them later. This is my phone number. Here's my email address. I don't charge anything to answer questions about whatever we're talking about tonight or other business matters. I'm happy to try to help. Here's my blog address, tomcopelandblog.com. I've got hundreds and hundreds of articles on all aspects of the business side. You can also see my training schedule. I do monthly webinars through the Association for Family Child Care. In addition to traveling to Wisconsin, Green Bay in May, I do trainings all over the place. My blog gives my training schedule. Now, I'm not doing your taxes here, not providing you with individual professional assistance. If you need that, you should seek that out. So what you have as handouts are a series of tools, little handouts, things that we hope will be helpful in your business skills. And so they're divided into these areas. Good record keeping makes good financial sense, the ABCs of record keeping, benefits of the food program, contracts and policies, money management, and retirement. So this webinar is essentially going through these handouts, talking about what they cover, explaining how you can use them, address some of the major issues that you should know about. So we start out by saying, do you love the business? Well, and I'm looking at the handout that says good marketing makes good financial sense. Probably not. Most people who love caring for children love record keeping. And I understand that. But there are things you can do that are fairly simple.
Tom,
make this easier.
Tom, you're
Go ahead.
You're kind of cutting in and out.
Yeah.
It may be a bandwidth issue, which we kind of talked about.
I don't know.
I
I can use the telephone. I can use the telephone.
Are you using a headset and mic?
No, I'm just using what we done the practice thing, just the speaker out of my computer.
Well, I think it's possible that it would take less bandwidth if I took control of the PowerPoint back. So
Okay.
Is it okay if we try that and you just tell me when to advance the slide?
Fine. Do you want me to use a headset? I can.
Try continuing with the headset and we'll see if changing the presenter makes a difference. So thanks everybody for your patience.
All right, so I'm using a headset now. I don't know if that makes a difference. Does that make a difference, Andrea?
It sounds good, so.
All right, should I keep going?
Yeah, do you want to show the slides or shall I? Because now it's on my screen.
Why don't I can click through it, but if you feel more comfortable clicking, I'm fine with that too.
Well, let's try it with you doing the slides. Now you're showing your screen, and we'll see if the headset made a difference. So.
Okay, so let's. Sorry, everybody. Let's see if this is any better. So, good record keeping makes good financial sense. The better your records, the lower your taxes. You may not like doing record keeping, but there's a big reward for doing it properly. And the simplest way to explain that is for about every $10 of deductions, claimed expenses you put on your tax return, you're going to save about $3 to $4 in taxes, which is significant. And the $3 to $4 comes from you're going to pay about 15% Social Security tax, you're going to pay some federal and Wisconsin income tax on your profit, And depending on your family's circumstances, that represents between 30 to maybe 40% in taxes. So your taxes are going down by about 30 to 40% for every dollar you claim on your tax return. That's a lot. Here's another way of looking about record keeping. For every 2 hours you work in your home, whether it's caring for children or doing other business activities in your home, that represents about 1% of the week, and that means you can claim another 1% of deductions, expenses associated with your house. And since you're entitled to claim so many expenses associated with your house, property tax, mortgage interest, utilities, house insurance, house repairs, depreciation on your house, thousands of dollars. If you had $10,000 of house expenses and you worked another 2 hours a week, every week, that's another percent. That's an extra $100 deduction just for that 2 hours of work. So tracking 2 hours of work a week is a lot of money. This is money in your hands. Record keeping has an immediate payoff. Another way it has immediate payoff is claiming snacks. Claiming snacks that you're not reimbursed by the food program. If you claim one snack for one child for a year, that represents $190 in tax deductions, just that extra snack. So the record keeping associated with tracking the extra snack, I don't think is a lot of work, but it quickly translates into a lot of money. So record keeping, not fun. Record keeping, however, has a big payoff. Now, knowing that, the next question would be, well, why don't more providers keep on top of this and keep all these good records? This is the time of the year I'm looking at people's tax return, I'm answering a lot of tax questions, and in many cases, providers aren't keeping all the records they should be, and it's making a difference when it comes tax time. And so now what? What's the problem? Why aren't people doing this? There are a lot of different reasons. I don't want people to blame themselves or hit themselves over the head, but people say, well, it's too much work. I don't have the time. It is work. It is work. But you're probably going to earn more per hour doing record keeping than you're earning per hour caring for kids. So this is worthwhile. Some people say, I don't even know where to start. And the place where you're going to start, and we're going to talk about this in a minute, the 3 key things you want to be doing is keeping receipts for expenses associated with your house, keeping track of all the meals and snacks you serve, and tracking the number of hours you work. We're going to talk about those in a little more detail, but that's where you start. House expenses, meal counts, hours worked. Those things have the biggest impact. That's where you get started.
Tom, just quickly back to the previous slide. Can you just repeat that about the money? Every dollar earned is what?
Is this the slide you want me to look at?
Yeah, it's where you started here, I think.
Well, for every $10 of expenses, your taxes are going to go down by about $3 to $4. Is that what we were talking about?
Hopefully that's what you mean, Misty. If not, let me know.
All right. You're paying taxes on your profit. The money you get from parents and the food program, from the subsidy program, that's your income. All the expenses associated with your business get subtracted from your profit, from your income. Sorry. Income minus expenses equals your profit. After expenses, what's left over, that's your profit. You're going to pay tax on that. You're going to pay about 30 to 40% tax on that profit. Every additional deduction that you can come up with, every additional dollar you can deduct, your taxes are going to go down by about 30 or 40 cents. So deductions are very, very valuable. Keeping records will increase your deductions, will reduce your profit, will reduce your taxes. All right? Some people say, well, this is too overwhelming. I'm bad at numbers. I don't know how to do all this stuff. The handout talks about this, how to organize, how to make a little more sense of these record-keeping rules. It's not overwhelming. I think people can plug away try to do something a little bit better this year, a little bit better next year. It's not something you necessarily have to master all at once. You could also get help from tax preparers. You could call me throughout the year and ask questions. It's not something that comes naturally to people, and it may take a little time. If you make some big mistakes, it's not the end of the world, because you could always amend your tax return back 3 years. Just talked to a provider today who realized she hadn't claimed all the house expenses that she should have in 2014, so she's going to amend her return and get a refund. So you can always fix things later. So don't try to worry that if you don't get everything right now, it's the end of the world. It's not. And some people object or don't like to do record keeping because they think it won't make a big difference. Well, I think as we've illustrated a couple times, yes, it can make a significant difference. It is well worth your time. Will keeping good records make a difference? Yes. Here's another example. This handout called The Real Benefits of Keeping Good Records shows an example of somebody who first, before doing these 3 most significant things we've been talking about, saving receipts associated with a house, tracking meals and snacks, tracking hours, if they're not doing a particularly good job of that, this person ends up paying $5,000 in taxes. When they focus on these 3 rules, their taxes go down by a little more than $1,000. How so? Well, if you pay a little more attention to keeping track of all the receipts and expenses associated with your house, let's say you realize there's an additional $1,000 of deductions that you're claiming. What do I mean by that? You can claim expenses for everything associated with your house. The welcome mat, the doorbell, paying somebody to mow your lawn, the lawnmower, the snowblower, painting your house, service contracts on your appliances, Tupperware, floor polish, window cleaner, everything associated with cleaning, repairing, maintaining your home, garden hose, wheelbarrow, rakes and shovels, curtains, shades, blinds, on and on and on. So let's say you come up with an extra $1,000 of those receipts. That represents, in this example, about $100 saved on your taxes. What if you claimed 1 extra snack? And under these circumstances, you had 6 kids, your taxes are going to go down by $381 simply by tracking that extra snack for those kids. What if you pay closer attention to the hours you're working and come up with 10 more hours a week of things that you're doing, such as record keeping, meal preparation, cleaning? That'll save you about $583 in this example. This handout, I think, can be very useful in pinpointing what a difference this makes. What a difference record keeping just on these 3 points can make. All right, shifting gears slightly. There are child care providers out there who are operating illegally, meaning they're in violation of the state licensing rule. I'm not talking about people who are exempt from the rule and are only caring for 1 or 2 kids. I'm talking about kids who are caring for 4 or more kids and are not licensed. They're operating illegally. I think we'd all agree this is not good. It's not good for children. It's unsafe. And I think we'd all agree it's unfair competition. You have to follow all these licensing rules. You have to do a lot of other things that sometimes cost money. And yet there are people out there that you're competing with who are probably charging less and are not following all the rules. So the handout that accompanies this talks about what you can do. I would start with reporting this to your local licensor and see what they're going to do as follow-up. And that if that's not doing anything, you could contact your local police department. And as a last resort, you could contact the IRS and turn them in. And I give the contact information on the handout. You don't need to know their Social Security number. All you need to know is this person's caring for more than 4 kids, and we suspect that people in that situation aren't reporting all their income, and as a result are probably cheating the IRS. And the IRS wants to know about this. And I think the police should know about this, and certainly the licensing should know about this. I think it's something that only providers are in a position of taking some action to try to address this problem. It's not good that we have an industry that there's so many people doing it against the law. Different topic, grants, Youngstar micro grants. Do you want a micro grant? Yes. What are the tax benefits of receiving one? Well, if you're getting money, or if you're getting materials, toys, equipment, whatever, stuff, whether you're getting cash or stuff, that's income. The value of the grant, the money, or the income can be deducted as a business expense depending on what the items are and how they're used. In most cases, there's not going to be any tax impact. You're not going to pay more in tax in many of the cases. In some cases, you may have to pay some additional tax, but in most cases, it will be very small. And the handout goes through 5 different examples of the tax impact. For example, if you get a $250 grant and buy $250 of children's materials that are only used by daycare kids, you're going to report $250 as income and $250 as an expense. And so that'll wipe it out. No tax consequence at all. If you get $250 grant, $250 worth of materials, and spend it on $250 worth of materials, and these things are also used by your own children when the daycare kids are not in your home, then you can't deduct all of it. You still report the income, but then you're only deducting a business portion of that. But as the example showed, still the difference is small, and the extra tax is small. The way to look at a grant is, even if you are paying a little bit more in tax because of the grant, it's still a deal. I mean, you're still getting something worth a lot more than the tax you have to pay. All right? If you're getting, in my example here, you got a $250 grant, and in the end, taxes on that would be maybe $50 or $60. So to pay $50 or $60 in taxes to get $250 worth of stuff, that's a deal. That's still a deal. And another example is if it's larger items, playground equipment, things that may have to be depreciated. Again, in most cases, still minimal tax consequence. Therefore, if you're getting a grant or thinking about getting a grant, you shouldn't be saying to yourself, well, I should turn down the grant because somehow my taxes might go up. Well, maybe, but if they do go up, it's going to be, again, a very small amount. And the value of getting the grant to improve the quality of your program, I think, should outweigh paying a little bit extra in taxes. All right, startup costs. For new providers, people just thinking about this, the handout lists some of the items that you might need to get started. Many providers have a lot of these already. Some of these things you may have to buy, smoke detectors, fire extinguishers. You may need a fence. You may need some well water testing and so on. Some of the children's equipment you may already have, tables, cots, sleeping bags, cribs, some outdoor play equipment, indoor play equipment. So how much you might have to spend on startup costs vary depending on your circumstances. In general, they're going to probably be relatively small and are usually not any kind of significant barrier to getting licensed in the first place. So the handout can be used as sort of a way of tracking if you want to and analyze this ahead of time. What are the things I need that I don't have already? What do I think they're going to cost? So you can get an idea before you get too far into the process of what those costs might be. All of the costs on the handout are tax deductible. And so your taxes are going to go down when you spend these things, buy these things. And there's so it's not really costing you as much as you think because it's deductible. So that's the end of the first section. Andrea, do you have questions at this point that you've heard?
There's a couple specific ones that I'm not sure if you're going to get to, but are you going to cover how do you keep private from business expenses separate, like glass cleaner and floor
Ah,
cleaner?
um, yeah. Let me address that now. The the general rule is this: if you buy something that's only used for your business, you can deduct all of it. That makes sense. So if you're buying children's activity supplies and curriculum that's only used for daycare kids because you don't have kids or your kids are grown, then you can clearly deduct all of it. You buy a TV that's only used by daycare kids, you can deduct all of the TV. For things that are used by your business and by your family, logically you can't deduct all of it. You can deduct part of it. And none of the handouts go into the specifics of this, but essentially you're claiming part of the cost by calculating a formula that's known as the time and space percentage. It's based on how much time you're using your home for your business and how much space you're using your home for your business. This information is filled out on a tax form called Form 8829, Expenses for Business Use of Your Home, Form 8829. And on that form, you're going to be asked how many square feet are you using in your home on a regular basis and how many hours are you working in your home. So, for instance, if you work 11 hours a day caring for kids, that's 33% of the year. If you spend another 12 or 13 hours a week on other business activities, cleaning, record keeping, and so on, that's about another 8%. So for most people, the percentage of time that they're working in their home is around 35-40%, somewhere in there. Could be a lot higher if you're caring for kids in the evening on weekends. And space, go ahead.
Is there a limit to the number of hours you can claim for bookwork and
No.
cleaning when the kids aren't there?
No, there's no upper limit here.
Okay.
I've seen a provider as many as 20 hours a week that she was doing on other activities. It's just a matter of keeping records of it. No, there's no upper limit.
And just a couple questions on car insurance, too, I just noticed.
All right, hold that thought.
Okay.
The other part of this is the space. So how much of your home are you using on a regular basis? And if you're using a room 2 or 3 times a week, that's regular use. And most providers are using 90-100% of all the rooms in their home on a regular basis. So if our time percent is, let's say, 40%, and our space is, let's say, 90%, these two get multiplied together. 90 times 40 is 36%. Providers' time-space percentage is around 30 to 40%, somewhere in that range, which means you can deduct about 30 to 40% of all these shared expenses associated with your house. Light bulbs, toilet paper, cleaning supplies, property tax, mortgage interest, utilities. That's how we're dealing with the shared expenses. Okay, what was the other question then?
A couple questions about car insurance. Can I claim it if I don't transport the kids? How do I claim personal vehicle mileage?
Yeah. You can claim car expenses for trips that you take in which the primary purpose of the trip is primary purpose. More than half the reason for going somewhere has got to be business. So taking children somewhere, field trips, taking them home, that's a business trip. Going to the bank to deposit money, going to the library to get children's books, those are all clearly business. Going to the grocery store when you're buying more business food than personal food, that's a business trip. All right? You need to keep records of this, receipts, mileage log, calendar notations, credit card statements, canceled checks, etc. There are 2 ways to claim car expenses. You can use a standard mileage rate in which you just add up all the miles you drove for business multiplied by this number. For 2015, it was 57.5 cents a mile. For 2016, it's 54 cents. It went down. 54 cents a mile. If you use this method, for this year, you get 54 cents a mile plus any parking expenses plus a portion of your car loan interest, but not car insurance and not anything else. The second way to claim car expenses is not to use a standard method, but to save receipts for all the actual expenses that you have to operate your car: gas, oil, repairs, car insurance, a car loan interest, car wash, jumper cables, ice scrapers, everything, and multiply it by a business use, and you can depreciate the car. The business use percent that we can use is the number of business miles you drove divided by the total number of miles. So if you drove 2,000 business miles and 10,000 total miles in the year, that's 20%. So now if you use the actual method, you can get 20% of all the expenses, including car insurance. If you use the standard mileage method, you get 20% of the car loan interest, and then 2,000 miles times 54 cents, and that's all. Okay?
There are a couple questions about if any of this applies to a group center as well, or is this just family, right?
What I'm talking about is if you're doing childcare out of your home, is that considered group? I think so. If you're doing it in your home and you're not a childcare center, a commercial space, a commercial building somewhere else, if you're in your home and you're caring for 7, 8, 9, 10 kids and got however many and have a helper, everything I'm saying applies in that situation. If it's a center, a separate building, 10, 20, 30 kids, 40 kids, then no, the rules are different. Other questions?
No, but Kelly's saying this only relates to family childcare, not group childcare. So
okay, Kelly knows this better.
Kelly,
So
he does.
So family childcare only, group care not. Thank you for that.
And in terms of all the time-space percentage questions, Kelly did a webinar last year on time-space percentage solely, and that is recorded. And so you'll have access to that, everyone. If there are continuing questions, we're happy to do a repeat of that.
Great. All right. Okay. So next area here, ABCs of record-keeping issues. There are a number of record-keeping systems out there that can help make this a little bit easier. And if you need this kind of help, this is where to go. There's software. There's KidCare, formerly called Minute Menu, which is a record-keeping program specifically designed for family childcare. It includes the ability to track all your food program records, and in addition, track all your expenses. So it'll track the miles, it'll track the hours you're working, it produces a whole series of reports. You can use it for 30 days for free to check it out. It's now being called KidCare because they're upgrading it, and they're now making it available on any platform, a Mac, an iPad, an iPhone, and the accounting section will be upgraded, I'm hoping, within the next month or so. They're working on it right now, making some nice upgrades. There's also the CACFP.net, allowing you to file food program claims electronically, and it has some other business record-keeping features there, and it's free through a food program sponsor. There are calendars, the Red Leaf Calendar Keeper, which has been around for almost 30 years, which has charts for each month you can track income, expenses, and so on. Forms, Facts, and Figures is another workbook that can help you with records, as well as the Nutrition Calendar and Record-Keeping System. The handout gives you information on how to access all of them. There are two toolkits. The Child Care Toolkit from Wisconsin that has a series of folders where you can put all your records in folders and help organize them. The Family Child Care Business Kit is a cardboard box with folders in it that's produced by the National Association for Family Child Care. For each folder, the topic is on there, and then examples of what to put in the folder. So one of the folders would say supplies, and then it would list a whole bunch of things that you could put in the supply folder, or children's records, or food program records, and so on. What else? Online spreadsheets out there, Excel, Google Sheets, others, QuickBooks. Some people like QuickBooks. There's no one answer here. I mean, people use all these different resources, whichever one you feel most comfortable with, or talk to other providers who use it to take a look at them. This can make your job easier for sure. What records do you need to keep? A variety of records. You need to save your records for at least 3 years after filing your taxes. So for filing your 2015 taxes that are due in a couple days, you would need to save all those records until April 2017, 18, 19. 3 years from the deadline of filing the tax return, April 2019, keep your records. I would save them for 4 years just to be on the safe side. And now that I'm thinking about this, I think Wisconsin may require you to save your records for 4 years. I would save everything for 4 years. Why? You want to defend yourself if you ever get audited. The IRS can audit you back 3 years. Right now, they can audit you for 2014, 2013, 2012. They're not going to audit you for 2012 at this point because by the end of next week, the deadline will have passed to audit you for 2012. So we're home free for 2012 and the years before that. You also want to keep some records if you ever might need them for licensing investigation purposes. And if a child is ever injured in your program, you want to save records and forms you filed around that in case you later get sued. So for record-keeping purposes, you're just keeping records of all income and all expenses. The legal records for insurance purposes, save your insurance policies. Do a household inventory of everything in your house in case there's a fire or a storm that damages stuff so that you'll know what you lost. And having an inventory can help get you more money from your insurance. And saving any particular licensing or parent records that licensing is requiring you to save. And the handout is more specific about the specific kind of records you should be saving. All right, we're going to come back now. We mentioned this before. We're going to talk about this in a little more detail. From a tax record-keeping point of view, which is what we've been talking about so far, these are the 3 most important things. I want to emphasize it again. When people get audited, that I help, when I'm looking at people's tax returns, this is where people are falling down and as a result paying too much in tax. So these are the things, if you're not organized, or how do I get started, how do I make sense of this, or what's most important, this is it. This is what's most important. Save receipts for everything associated with your house. Track all the meals and snacks you serve. Track all the hours you work. So let's look at that. Save all the receipts associated with your house. You can deduct hundreds and hundreds of household items. The tax rules say that you can deduct all ordinary and necessary expenses for your business, all ordinary and necessary expenses. And in your business, that means all expenses associated with maintaining your home as a home, because your job is providing a home environment for children. Parents expect you to maintain your home as a home. So if you've got broken windows or burning tires in your front lawn or wallpaper coming off the walls or holes in your floor, no, this is not family chocolate. This is going to harm your business. So all expenses associated with your house, virtually all of them, you're going to be able to deduct at least part of them. As I said, we want to save our records for 4 years. What if the receipts fade? And that can happen because of the ink or the paper. They fade. Well, that's not going to help you in an audit if you show up with a box of blank pieces of paper. So what are you going to do? Scan them into a computer or make copies of them? If you're scanning them, you don't need to save the paper receipt. I don't like throwing anything away, but the IRS rules say if you scan a receipt into your computer, that's as good as the original. If you're scanning, you need to make sure you're backing up your computer or saving it on the internet, and because you don't want to lose it. I wrote an article earlier this week about Neat, a Neat app scanner that allows you to organize your records. There are other products out there that I mentioned in the article. This is something that more and more providers are doing. Now, I would recommend that you save all receipts, whether they're business or personal. Why? You buy a toy for your own child. Merry Christmas, happy birthday. Personal, all right? Can't deduct it. But does your child later allow the daycare kids to play with the toy? Maybe your child's outgrown it. Maybe your child's just, allowing the children with it to start with. Now you're using it in your business, and now you can deduct part of the cost of that toy. You weren't thinking about business when you bought it. It was for your own child, but later it turns out it's partly deductible. So save receipts. I think it's easier to save receipts for everything rather than worrying at the time, well, is this deductible, is it not, I'm not sure. Just save it all. Later, you can sort it out and say at the end of the year, okay, no, this is not deductible. But things that you might not have thought of, by the end of the year, you realize, hey, I could have deducted that. Save the receipt. Track all the hours you work in your home. Of the three things that we're now talking about, this is probably the most important one. The single most important way you can reduce your taxes. Why? The more hours you work, the higher your time and space percentage. So what I prepared as the handout is a spreadsheet that you could use to track these hours. First, there's the hours the kids are in your home, and most people have reasonable records for that. We want to know from the moment the first child arrived until your last child left. The only thing about that you may want to pay a little closer attention to is the pickup time. If kids are supposed to be picked up at 6, but the last parent is not walking out your door until 6:15 or 6:30, you want to capture those extra 15 or 30 minutes. It's not when the last parent signs out, it's when they walk out. So if they sign out at 6:10 and they talk to you and they don't actually walk out the door until 6:30, you want to go back and write down 6:30. Because a half hour a day, every day, of extra time here from 6 to 6:30 is equal to 1% of the year. And with thousands and thousands of dollars of house expenses, an extra percent makes a difference. All right. Now, hours kids are not there, because that's what this slide is about. That's what the handout is about. What I'm suggesting is you track 2 months carefully, all the hours of work you did in your home when kids were not there. Track 2 months carefully, then use the average for those 2 months for the rest of the year. And you need, according to the Quality Stars rules, you need to track one of those months in the first 6 months of the year and one of those months in the second 6 months of the year. So we still got May and June to do this for the first part of 2016. And the handout represents 1 month, 4 weeks, and then you photocopy it for another 4 weeks. And it gives you categories of things that you might be doing when kids are not there. Cleaning, email, internet activity, family, child care, association activities, food program paperwork, meal preparation, parent interviews, phone calls, preparing activities, record keeping, other things. You can only count this time if you're in your home. So for example, that if you're in your home right now, the time listening to this webinar, you count this time. You have an association meeting in your home, count that time. You're cleaning for a half hour before the kids arrive, count all that time. You clean for a half hour after the kids are leaving, count all that time. You're cleaning on Saturday and Sunday, the kitchen, the bathrooms, count some of that time. Parents call you in the evening, and so on. This is a big, big deal. Most providers are not keeping 2 months of records and are guessing and are way underestimating. So track it carefully for 2 months. Do it for May. Do it for September. Use that average. If you worked 40 hours a month on these things in May and 44 hours in September, the average is 42 hours for those 2 months, then use 42 hours for the entire year. Every year, do 2 months. Every year, 2 months, use the average for those 2 months. You'll be surprised, I think, at how many hours this can add up to and how big a difference it will make on your taxes. Questions about that?
Just a couple clarifications about how long to keep receipts. Somebody thought it was 5 years and was told that by the IRS, and then Sandra said what happened to 7 years. So I'm not sure if we're talking about keeping receipts or keeping tax returns.
Yeah. There is no 7-year rule. There is no 5-year rule for the IRS. There is a 3-year rule. There's no 5-year, there's no 7-year rule. I keep hearing about that, but it's just not the case. If somebody's telling you something, then you want to say, where does it say that? And so if somebody wants to send me an email and say, Tom, where does it say 3 years, I'm happy to show you that. But there just is no 5-year rule or 7-year rule for these records. Okay?
And there are a couple questions about the food program claiming that I think you're going to get to.
I'm going to get to that.
What about if you buy something secondhand? Should you get a receipt?
Yeah, garage sale, Craigslist, whatever. A receipt would be a note that says, you know, used high chair, $10, cash, signed by the person who sold it to you. That's a receipt. However, most people don't get that when they go to garage sale. You're not, you know, you could write that out on a piece of paper as you're buying it and ask the person to sign it. That is a receipt. Most people don't do that. You get home, you got the used high chair, now what? You make your own record, a written record, and so you write out a note. Garage sale, Smith Avenue, 1400 block, whatever you can remember, or east side of town, that's all I remember. Used high chair, $5, paid cash, put the date. And then take a picture of the used high chair. That's an adequate record to claim that expense. If you've bought things earlier in the year that you didn't do that for, now's the time to go ahead and do it. I mean, dig those things out. What did you buy so far this year you don't have a receipt for? You lost it, you forgot it, you never had it in the first place. Take a picture of all these things, write out to the best of your memory where you bought this stuff and how much it cost. You're estimating it if you have to. The pictures are going to support whatever you deduct. Okay?
And what about if you lease a car? How do you claim that?
Leasing a car you can claim as an expense using either the standard mileage method or the actual method I described earlier. If you're using the standard mileage method, you still use the 54 cents a mile. If you're using the actual method, then you take the cost of the lease plus gas plus car insurance plus anything else. So leasing still gives you the option of either method.
What about, can you claim yard work time or can you claim outside yard work?
Yeah, when I say time spent in your home, that would include spending time outside working in the yard. However, you can only count time if you wouldn't be doing it if you weren't in business. In other words, if you're mowing the lawn on Saturday, aren't you still mowing the lawn if you aren't in business? Yeah, therefore I wouldn't count the time mowing the lawn. If you're outside picking up after the daycare kids, picking up all the toys, certainly count that time. If you've got a swing set and a jungle gym and you're adding mulch or you're just, you know, cleaning up that area, you're fixing it up, yes, because if you weren't in business, you wouldn't be doing that. So that's how you think of it. Same thing with inside the house. You know, you normally take out the garbage, so I wouldn't count that time. You know, you normally do some house cleaning, don't count that time. Count the extra time spent house cleaning.
And is anything different if you don't own your own home?
If you're renting your home, no, everything is the same. Now you're claiming the time space percentage of the rent and utilities if you're paying utilities. So you don't have the property tax and the mortgage interest, but you can still deduct everything in the home that you bought and still calculate your time and space percentage in the same way.
And you're claiming the cost of items including their tax?
Yes, sales tax is part of the cost of the item. So yes, include sales tax.
Okay.
All right?
Yeah, let's move on.
Okay, so this is the last of the three most important things. Track the meals and snacks that you're serving. Food is often your biggest expense. So I created this spreadsheet that you could use if you want to help you track the meals and snacks you're serving, particularly those that you are not reimbursed by the food program. That's probably the main purpose that you might want to use this spreadsheet for. All the meals and snacks that you're serving that you're getting reimbursed by the food program are deductible. And your monthly claim form will indicate how many meals, breakfast, lunches, snacks you served, because you can deduct all those. But the additional meals and snacks, the food program reimburses you for 2 meals and a snack or 2 snacks and a meal. So let's say you serve breakfast, morning snack, lunch. The food program will reimburse you for those 3 servings. But now you're serving an afternoon snack, or maybe 2 afternoon snacks. You're not getting reimbursed by these extra snacks. You're not probably recording these on your monthly claim form. Therefore, it's up to you to keep your own record to show that you serve these extra meals and snacks. And as I said before, this is important. 1 snack a day for 1 child for a year is $190. So this chart, this spreadsheet that we give you, you just put the name of the child, and for each day of the week, you just put a check mark by the snack. Snack, 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 snack. We don't need a menu. We don't need a recipe. We don't care what it is. It doesn't have to be nutritious. It's not being reimbursed by the food program, so you can serve a popsicle in the afternoon at 1 o'clock and some Twinkies at 3 o'clock, and that's 2 snacks. I'm not telling you to serve junk food. I'm just saying whatever you serve counts. The writer says, as the kids are leaving at the end of the day, I give them some crackers as they go out the door. That's another snack. And that's another $190 per child per year. So this form you can use. It's a weekly form. You can photocopy it, use it for each week as a way of tracking the unreimbursed meals and snacks. If you're using Minute Menu software, you can go in there and put the extra snacks in there if your sponsor will allow it.
But you can't claim meals that are reimbursed by the food program.
No, you can.
You can.
Yes. You're getting reimbursed for serving breakfast, lunch, snack, let's just say. Those, okay, you're getting money for those. And we're going to talk about the food program in a second. You're getting money for those, but you can count those meals and snacks as a food deduction in addition to the extra snacks you're serving. You're going to add them all together and claim them as an expense, and we'll talk about that in just a second. All right? Last handout of this section. Record keeping, as we started off by saying, is no fun, and then, man, there's a whole lot of things to it. How do we keep on top of all this stuff? I would suggest, if particularly if you're just getting started, or if you just have a general difficult time getting organized, to review your records monthly, to keep on top of things. It's easier tracking things monthly than at the end of the year just to add up 12 months of records, rather than at the end of the year face a just enormous pile of things and wonder yourself, did I keep everything, and trying to remember. So I created this spreadsheet checklist as a monthly reminder of things that you should be doing each month. So the checklist would say, did you record all the payments from parents that you got? Did you submit your food program claim form? Did you record all your attendance records? Did you record all these meals that we're talking about, particularly these unreimbursed meals? Did you do that? You sort of check off, yeah, I did that. Did you keep all the receipts for things you bought that month? And then you get to the end of the month and you say, I'm not sure. Well, now's the time to go back and try to track it down. Oh, I lost one. Okay, now's the time to reconstruct it at the end of the month when you're going to remember more likely what the heck it was. Did you track all the hours you worked? We have a whole separate spreadsheet on that. Did you record all the miles you drove that month? Oh, I forgot to, we went to the park. I forgot to write that down. Now you write it down. So each month, this is like a reminder to go through it, to look it over and say, okay, did I do all these things? And if you're keeping on top of it like this, your records are going to be much more accurate. your taxes are much, much more likely to be lower because you have what you need to do your taxes. All right. That's the end of that section. And so now we're moving into the food program, and we can answer any questions associated with that. You're always better off financially by joining the Child and Adult Care Food Program. And this is something that, unfortunately, I still get calls from providers who tell me, well, my tax preparer says I shouldn't because my taxes are going up, or my friend told me I shouldn't, or I was on it for a while and it wasn't worthwhile, I dropped off, whatever. No, you're always better off financially. You always want to be in the food program. Money you get from the food program is taxable income, with the exception that if you're getting reimbursements for your own children, that money is not taxable income. Any food you serve to your own children is not a deduction. Any food that you eat in your home is not a deduction. Any food that the daycare kids eat in your home is a deduction. So, here's the way I would try to explain this. Do you want to win an extra $567 or $1,180 per year per child through the lottery? What if the lottery, that's how much you won each year in the lottery? Would you want that? If your spouse got a raise of $567 or $1,180 a year, each year, would you take it? That's the financial impact of getting reimbursed for one child for 1 year on the food program. The lower number is if you're getting reimbursed at the lower Tier 2 rate. The higher number is if you're getting reimbursed at the higher Tier 1 rate. This assumes you're serving a breakfast, a lunch, and a snack each day. If you're caring for 4 kids at the lower rate that everybody is eligible for, that's over $2,200. If you're getting reimbursed at the higher rate, that's $4,700. You can get reimbursed at the higher rate if you live in a low-income area, or you're serving low-income kids, or your family is low-income. And you can ask your food program sponsor about the details and filling out a form to find out. Otherwise, if you're licensed, you're always registered, you're always eligible for the lower rate, the Tier 2 rate. Now, one of the handouts talks about the tax after-tax impact, showing that even after you pay the tax, you're going to have more money left over. So, and I give you some numbers there. So in other words, some people shy away, oh, my taxes are going to go up. But as this handout shows, yes, but the same thing is going to happen if you win the lottery, or if your husband gets a raise, your taxes are going up. But you pay those higher taxes out of the extra money you're getting, and you have money left over. So this is a summary. There's another handout, common objections to the food program. And these are the ones that I hear about over the years. Dom, I don't like the food program. It's more paperwork. It's a pain in the neck. Well, okay, it is more paperwork. That is true. Although if you're not on the food program, you still need to keep the records of attendance and how many meals and snacks you served to be able to deduct your food expenses. So, yes, it is more work, but some of that you would have had to be doing anyway. But the way to think about this extra work is, how well are you being paid to do this work? And in going through the handout example, if you're caring for 4 kids and spending about 3 hours a week on paperwork, you're earning about $14 an hour if you're at the lower reimbursement rate, or over $30 an hour if you're at the higher rate. In other words, you're earning more per hour doing food program paperwork than you're earning per hour caring for kids, usually a lot more. So, yes, it's a job, it's an additional job, but you're getting paid a lot for it. Next objection. But I'm going to pay more in taxes. And this is what kills me when tax preparers say this. Oh, don't be on the food program, your taxes are going up. Yeah, but you're going to have more money after you pay the taxes. Would you like to be a millionaire? Well, if you are, your taxes are going up. Do you still want to be a millionaire? Absolutely. Because maybe I'm going to pay hundreds of thousands of dollars in taxes that I didn't have to pay for before, but I'm going to have hundreds of thousands of dollars left over. So we don't look at the taxes as being significant. We say, how much do I have after I've paid the taxes? Next. Tom, this money will kick me into a higher tax bracket. And what people mean by that, they think that if the food program income, if they get it and they report it, it kicks them in a higher tax bracket. Therefore, they think that now they're going to pay higher taxes on their other income, husband salary, on their income, and so on. And that's just not true. If the food program money did kick you into a higher tax bracket, all that means is some, if not all, of the food program money you'll pay a higher tax rate on than your other money. But all your other income will never be taxed at a higher rate simply because you're in a higher bracket. It's only the food program money that is paid at a higher tax rate. And again, even if you're paying a little bit more in taxes on the food program, you're still better off. Money.
Tom,
whether you're paying 30% tax on it or 40% tax on it.
You're breaking
Yeah.
up again. Tom, can you just repeat that?
Yeah, the higher tax bracket is only an issue for the money you're getting from the program. Your food program money will now be taxed at 30%, and if it kicks you into a higher tax bracket, taxed at 35% or 40%. In other words, your food program reimbursements could trigger a higher tax bracket, but only for that money. All your other money, business and personal income, will not pay more tax on it. So whether you're paying % tax on your food money or 40% tax on your food program money, that's the only thing that's being affected. You're still better off getting that money than not getting that money. The last objection is really a non-financial objection. I don't like food program people or anybody from the government coming into my house. I don't like following any government rules or people looking over my shoulder at what I'm serving kids. I don't like that. All right, I understand that, but by not being on the food program, that means you are giving up a lot of money. You're giving up $550 or $1,100 per child per year. So just as long as you understand that, the financial sacrifice that you're making by not participating. All right. Here's another way of saying it. Why should I stay in the food program? Some money is better than no money. Tom, I'm only getting 20 cents for a snack. If you're getting the lower reimbursement rate, they're reimbursing you 20 cents for a snack. You might say, well, of course it costs snack, so this is not worth it. Well, no. If you had 4 children, keeping records, okay, I got to record who's eating snacks today. It takes me 5 minutes a day for that. I got 4 kids. How much you're being paid per hour for that work? $9.50 an hour. That's how it works out. So you're still earning money. Yes, 20 cents is not covering the cost of food, but getting 20 cents for a snack is better than getting 0 for a snack. And then people say, well, I want to leave the food program, and then I can charge parents for food. Well, I don't think that makes a lot of financial sense. Now, some people do that. Parents want to bring their kids their own food. Okay, fine. But if parents brought everything, milk, juice, everything, and you didn't spend a dime on food, then okay, I could see that. However, there are a lot of providers who are spending less on food than they can claim as a food deduction using the standard meal allowance method. In other words, for this year, you get 74 cents for a snack. And it's quite possible if you served a banana or an orange, that would cost less than 74 cents. In which case, you're spending, let's say, 60 cents and getting a 74-cent deduction. So having parents bring food even if you didn't spend money on food, you'd still come out worse financially. Another way of thinking about this is, if parents are willing to go to the time and effort and expense of bringing their own food, wouldn't it be easier for parents just to say, hey, parents, don't bring the food? You could raise your rates and pay for the food yourself and be able to deduct it and get on the food program. So, yes, I can see some reasons why people may want parents, or parents really want to bring their own food. Okay, but as a general rule, you're sacrificing. You're losing money. You're ending up with less money in your hands at the end of the year when parents do that. So, pausing here before we go on to the next topic. Any other food questions?
I was muting myself, sorry. There are so many questions, Tom, about the food program that I feel like it warrants that if we have time at the end, let's come back to it, but I feel like we should do a whole webinar on that. A lot of very detailed questions from everybody.
As Andrea said at the beginning, I'm happy. I'll get a list of these questions. Yeah, and keep the questions coming, because I'll get a printout of these questions and then I'll answer them and we can send them out to people later if we don't have time at the end here. All right, so now let's talk about contracts and policies, some of the basics here. A contract is a written document that's legal, and we want written contracts, the purpose of which is not to take people to court, but which is to improve communication, avoid conflicts, make sure parents understand the rules, they're following your to keep. The key elements of a contract are the names of everybody, the names of the parents, the names of the child, your name. All those names need to be on the contract. The terms of the contract, meaning what are those things that can be enforced legally. It's the time, what hours do you open, what days do you open, are you closed on holidays, vacations, under what circumstances are you open or closed, and money. How much do the parents pay you? When do they pay you? Is there a registration fee? Is there a late pickup fee? Is there a future permission fee? Is there a supply fee? Whatever. You're giving me a headache fee. Whatever you're charging, that should be contract. Termination procedure. How will a contract end? I recommend not having an ending date in your contract. Just have a start date. This contract begins January 1st, begins March 1st, period. And then you can end it. If you have a date, then you have to worry about getting a new contract. So let's not worry about it. It doesn't help you to put an ending date. Signatures. You want everybody's signatures. If the two parents are there, you want both parents' signatures. If it's a same-sex couple, you want both parents' signatures. Whoever's paying you, you want their signature, because who's ever signed the contract, you can then enforce the contract against them. Policies are different than a contract. Policies are everything else about how you provide care. They're not enforceable in court. Parent is supposed to bring an extra change of clothes. That's in your policy. But they don't one day. Do you say to the parent, I'll see you in court? I don't think so. If you or the parent is unhappy about how the care is being provided, you can talk about it, try to work it out, but in the end, you can terminate them or they can leave. But you can't go to court over something that's in your policies. There's no rules, essentially, about what to put in your contracts and policies. And now I should stick with policies here. There's no rules about what you want to put them in there. Some people call them their handbook as well. So you're free to set your own rules, and you can change them whenever you want. Any change contract has to be in writing, signed by both people. So you want to avoid this problem. You're charging, I don't know what, $150 a week. One day you say to the parents, I'm raising my rates by $10 a week, $160 a week. Fine. You don't put it in writing. Everybody pays. 6 months go by, everybody's paying you now $160 a week. Now the parent leaves, and they leave owing you for the last 2 weeks of care. You can only enforce what's in writing, which is $150, because you didn't change the contract to reflect the higher rate. Policies, however, you can change at any time without a parent signature. You can just say, parent, I got a new rule, goes in effect today. Now, some providers have parents sign or initial the new policies. Fine. The purpose, again, of these policies is communication. We're not trying to catch parents to doing something wrong, but that's how we want to work it. So, again, written contract is legally enforceable, policies are not. And because of that, I recommend, you don't have to do this, I recommend you create 2 documents. Contract, time and money, sign it. Policies, everything else, my philosophy, everything else about how I provide care. You can have different rules for different parents. 150 a week. Now they come decide to raise your rates, but only for the new family. 160 a week. You can do that. Everybody else is picking up at 6. Now you have an opening. You're getting tired at the end of the day, so you don't want as many kids between 5 and 6. So you tell the new family you have to pick up at 5, and you're going to pay the same rate as everybody else, but your pickup time is earlier. You're treating parents differently. You can have whatever policies or contracts you want that are different, as long as you're not discriminating. You're not basing that difference on race, sex, religion, ethnic background, national origin, or disability. Other than that, you can have whatever rules you want.
And can a contract have fill in the blanks and still be enforceable?
Yes. Red Leaf Press has a fill-in-the-blank contract. There may be others out there. So you're filling in the blanks, and the parent signs it. That's a valid legal document. Yes.
Do you think parents should sign a contract stating they'll follow the policies of the center?
I think that's a good idea. At the very end, parent also, by signing this contract, parent promises to follow all my policies as laid out in my handbook. And then you're referring to the handbook, you're referring to the policies in the contract. Yes, it's a communication thing, so the parents are aware that these other rules they need to follow. Yes.
Do you have to report any policy changes to licensing?
No. No. If you want to, you can, but no, it's not a requirement.
Okay.
One policy here, a privacy policy. Increasingly, I think parents have a high expectation of privacy. And so I created a privacy policy that if you want to use, you can certainly use, that says, essentially, all information about families you're going to hold confidential unless you're required to release it by law. Licensing, the police, child protection, if you're those folks, governments can come in and tell you to release information, or if the parent gives written permission. Other than that, everything's confidential. You don't want to share any information.
Tom,
and I think being sensitive to this issue is a strong sign of professionalism.
So I think that in Wisconsin, I'm getting several reports that you do need to submit handbooks for review for licensing. Okay. Christy, Kelly, Catherine, thank you.
Sorry. All right. My fault. Should have known that. All right. Submit your handbooks and policies to licensing. Yeah, you got to follow whatever the child care licensing rules are, because you're essentially entering into a contract with the state when you get licensed. You got to follow their rules. So yes, do what they said, not what I just said. All right. So you got a contract. You got some policies. Enforcing them. This is where a lot of providers struggle, because many providers, hey, you're doing this, you love kids, not because you want to write up contracts and not because you want to negotiate with parents about money and stuff. So the thing here is it's up to you to enforce your own rules. Parents are not going to call you up and ask you why you're not enforcing your rules. To enforce your rules, you got to have a consequence for the parent's failure to follow the rule. So, if you're not doing anything, if they're breaking a rule and you're not doing anything about it, that's on you. You've got to step forward and say, wait a minute, parent, you got to follow my rule, or else this is what's going to happen. What is the or else? Parent, if you don't pay me on time, there's a late payment fee. If you don't show up to pick up on time, there's a late pickup fee. If you don't fill out these forms on time, there's a failure to fill out the form fee. Or termination. I don't want to deal with fees and penalties and all these things. Parent, if you can't fill out these forms on time, if you can't pay me on time, if you can't pick up on time, I'm going to give you a little leeway here, but I'm going to terminate because I just don't want to deal with it. Those are essentially your choices about how to enforce your rules. Providers who consistently enforce their own rules have fewer conflicts. So I would urge you to take a look at your contract, take a look at your policies. Are these things that you feel strongly about? And if a parent is refusing to follow these rules, are you willing to terminate the parent over that? If you're not, you should take the rule out because it's not a rule, it's a guideline. But if these are rules that, and the rules that I see that you have are reasonable, you're not asking for crazy things. So parents, I expect you to follow these rules, and if you don't, there's going to be a consequence. And the sooner you just are consistent about that from the get-go, the better. Or you can say, hey, I just attended this webinar, and now I've decided, parents, I'm going to start enforcing everything starting today, and just go forward with the new regimen. One of the more difficult issues in dealing with contracts is rates and talking to parents about rates. People are afraid that if they raise rates, they're going to lose parents. I'm not recommending that you raise rates. I'm not saying that. But in my opinion, your rates should reflect the quality of the care that you offer. So the higher the quality that you offer in comparison to other providers, the more you should be charging in comparison to other providers. I think it's easier to raise your rates if you're incorporating them into your written contract. So your contract might say, rates may go up in September or January, or 3% raise will be enforced over the next 2 years. You can be specific. You can leave it general about when it's going to happen, so that when its time comes, you can always refer to the contract. Okay, parents, according to our contract here, this is the time next month is when I'm going to raise my rates, and this year I'm going to raise it by 2%, 3%, 1%. Or my contract said this is the month I was going to raise my rates, but I decided I'm not going to raise my rates for whatever reason. But if it's in the contract, it's easier, I think, to enforce. If you want to, you can just put this in the contract for new families. If you don't want to deal with this with old families, that's fine too. I don't think you want to apologize or being defensive about your rates. Most providers do not raise their rates every year. Very, very few do. Most providers probably undercharge to private pay parents. If you compare the quality of your program to local child care centers, and if you think that the quality of your care is as good or better than local child care centers, then your rates should be comparable to that. Parents are paying higher rates at child care centers. What about paid time off? This is another way to go. You could, well, first of all, providers deserve a break. You deserve a break. Taking holidays, vacations, working 5 days a week, 52 weeks a year with no vacation. This is stressful. You need to rest. You need to recuperate. You deserve time off and paid time off. Again, you can say, okay, I'm going to have some paid time off just for new families if you want to do that. You can introduce this incrementally. I'm going to get 1 extra paid day each year for the next 5 years. You can put them in your contract. You can add them to your contract later. Sometimes, let's say you're going to take a 1 week or a 2 week vacation. You want parents to pay for it, and the parent says, "Wait a minute, that's going to be burdensome because I'm going to have to pay you and another child care provider for that 1 week or 2 weeks." And the handout that I gave gives you some examples of how to work around that by either raising your rates for the rest of the year for that family and then not charging them when you take vacation, or some other methods that you can incorporate that so that the parent is not paying twice. Last section. Questions, Andrea, before we go to the last section?
There's a specific question here about the Square app and depositing money or not depositing money, but using that. Does that mean something to you?
Yeah, the Square app is a little doodad you put on your phone and to swipe credit cards so that parents could pay you by credit card. Mine is not called a Square, it's from US Bank, so it's called something else. But I think that's what we're talking about. Accepting credit cards from credit card payments from parents as a way to avoid bounce checks, as a way to avoid parents saying, I lost my, forgot my checkbook or whatever. Accepting credit card payments. Sure, that is and you can swipe it right off your phone when you set that up through a local bank. Talk to your local bank about getting that.
Is it free?
And no, but it's not much. All right.
All for now.
Okay. Money management. Last section here. I want people to be more successful in managing their money so that you have more money now and in the long run. What we've talked about now so far around money has mostly to do with taxes and keeping your taxes low by claiming everything you're entitled to claim. But we also need to think about the future, plan ahead to try to reach financial goals. So to start, you got to set goals. And it might sound simple, but it's really true. People who write down their financial goals at the beginning of the year are much more likely to meet them than people who don't write them down. We all probably spend more time planning our annual vacation than we do thinking about retirement or financial goals each year. You should be looking at short-term goals, long-term goals. Prioritizing these goals, and my handout goes into more detail, of course, on this stuff. Okay, we've got 3 or 4 goals. Which one are we going to focus on this year? Which 2 are we going to focus on this year? Let's review how well did we do. Check in every 6 months or so. All right, we did pretty good on the first goal this year, but not so good on the second goal. All right, fine. Move on. Next year, let's set a new goal. The setting of goals. The taking some steps to try to meet those goals, you want to plug away at. You plug away at it. Things come up, things that happen, and you gotta spend some money to fix a car or fix something broken. Okay, but you want to keep at it. Many providers are not saving money for the future because they're just spending money today on short-term things today and not thinking about the long term. Setting small goals, achievable goals that you can add on to as the years go by. So think it's not with the tortoise and the hare race here. We're the tortoise. We want to just slow and steady will make the day. Paying yourself first. Specific long-term goal would be retirement. And clearly most providers, most people in this country aren't saving enough for their retirement because they consider that their lowest priority. Everything else is more important than retirement because that's where we're spending our money rather than saving it. So the handout talks about this, about tracking where your money is going, setting a small savings goal, and writing a check for that amount at the beginning of the month. Okay, $25 a month, $50 a month, $100 a month for my retirement. And then if you start running out of money before the end of the month, you got to cut something. And if that means cutting some eating out or cutting some clothing or cutting, fine. But retirement's got to be considered a high priority by paying yourself first. Most people who go through this exercise, if they write a check for a small amount of money for the retirement each month, don't miss it. Don't miss it. And if you had to cut something, you can cut it. And most providers, in my experience, can save. Here's an example, a sad example from today. I helped the provider by looking at her tax return. She ran family childcare out of her home, and she ran a small childcare center as well. Together, she took in $188,000 of income. What was her profit? Zero. And she's not saving anything for her retirement. And she's been doing this for 10 years. And she said, gee, Social Security, I'm not going to get much in Social Security because she's not contributing to Social Security because she's not showing a profit. So I said to her, she's paying the person running her center $73,000. The person running her center is making more money than she is. So I said, take a look at how much money you're making or not making from running a center. And if you're not making any money, maybe it's time to stop and focus on doing childcare in your home and to show a profit because you need to contribute to Social Security to get Social Security benefits. How much should I save for retirement? Well, the handout on this talks about this in some detail. Roughly speaking, if you want to maintain the same standard of living as you have now in your retirement years, you're going to need at least about 70% of your current income in retirement. And where's your income going to come from when you retire? Social Security, that will be around. Social Security, investments, interest from your investments, and what else? People work after they retire. Childcare is a physically demanding job, and maybe you want to work until you're age 70, but you might not be able to, depending on how your body holds up. And then what? So that's why people need to plan ahead. You need to figure out how much you should be saving. Obviously, the younger you are, the more time you have to save. And my handout lists several online calculators where you can plug in your information. How old are you? How much have you saved? How much are you earning? And so on. And they'll tell you how much you should be saving each year to meet a retirement goal. When you use these calculators, I would urge you not to get discouraged thinking it's impossible. Saving something is better than saving nothing. The more you save now, the less you're going to have to save, the less you're going to have to work later. And when you're saving money for your retirement, you want to make sure you're using the significant tax benefit of the IRA, the Individual Retirement Arrangement, IRA. Money invested through an IRA gets a big, big tax break. So you want to take advantage of the number of different IRAs that you are eligible for. If you put aside $25 a week, after 10 years, if it earns 8%, you're going to have $19,000. So that can get you started. The handout also describes a new IRA called a MYRA, M-Y-R-A, that virtually everybody is eligible for. You can invest in a MYRA, and it's guaranteed. There are no fees to get it started. You can dollars after that. So this is a new plan, new in 2015, that the IRS set up to encourage lower income people, people in general who don't have access to an IRA through an employer, self-employed. That's it. Handouts covered some key areas of where you might be able to improve some business skills. For the most part, by doing these things, I hope this is a way you can see how you can save yourself some time and money. I hope these things are very practical and that they're things you can do right away, starting by taking small steps. These things do get easier over time. Talk to experienced providers who have been doing it for a while. I think they'll tell you that. So good luck with that. Well, and if you want to contact me, here's my contact information.
Before you go, can you just repeat the IRA slide? I think it was breaking up the whole time. Do you have another minute? I see it's 8 p.m. on the dot.
Sure, I can stay longer.
Is that okay?
Yeah. The slide doesn't say MYRA. It's in the handout, and the details about doing a MYRA are on the handout.
So there are So it's 8 o'clock. It's 8:01, which means that I'm supposed to stop now. And I do want to respect the people that need to leave right at 8. So I would like to give the registry information. Tom, do you want to follow up with questions in emails, or do you want to stay on a few more minutes to answer some of these?
I could stay on. Why don't you do your thing, and then we'll answer some more.
Okay. So hold on just a minute. I'm going to take this back. All right, so there's the thank you. Thank you, everyone, for joining us, and thank you so much, Tom. This has been wonderful. Sorry about the audio issues. It's a bandwidth issue that we frankly have no control over, I'm afraid. I do want to let you know that if you had questions about the slides that were looping at the beginning, that WICA staff can answer any questions about Reward and Teach and the food program. And if you want handouts, if you'd like to purchase the little booklet, you can still purchase that. I'm not going to stop recording yet. Registry credits. So once I log off, which I won't do until after Tom is done answering these questions, you'll get an email with a link to a survey, and you'll be required to complete that for registry credit, and your feedback is really appreciated. So thank you, even if you don't want registry credit, for completing that. Here's the URL, which I will leave up for a little bit while Tom is answering these questions. And so if you're someone that is participating as a group and you are not going to receive this email, you can write this URL down, type it in just as it is to a browser, and that should take you to the survey. If that doesn't work, just please let me know and I'll email it to you. All right, so back to the questions. Again, there are so many food program detailed questions that I really think we need to do another webinar. So I hope everybody understands that and is okay with us not answering them right now. Hang on. So we're going way back to mileage. Do you think it's better to claim the standard mileage or keep track of expenses? Just a quick, what do you think about that?
The vast majority of providers use the standard mileage method simply because it's easier to use. I would say that probably more providers are better off using the actual expenses method because their actual expenses will probably be higher than the standard method. But the actual method is more work because you have to save receipts for everything. So it's you know, you can just decide what you're going to do. If you're going to do the actual method or you're not sure which method is going to be better, start saving all the receipts, and then at the end of the year take a look to see which is higher. Now, if you started in the first year you use your car, if you started using the standard method, in later years you can switch over to the actual method if you realize you're going to get a higher deduction that way. But if in the first year you use your car for your business, you use the actual method, you can't switch over later to the standard method. So if you're just starting out, if 2015 or 2016 is your first year, and you're not sure about this, use the standard method, which will give you the flexibility of switching over in later years if you want.
And can you deduct vet bills for your pets?
Well, if we're talking about dogs and cats, no. No. Now, you might say, hey, they're involved with the kids and they learn with the pets and all that stuff. But the IRS, in my 30 years of experience in audits, have never accepted expenses associated with a dog or a cat. I even had an audit where the provider declawed her cat and had the receipt from the vet hospital on declawing her cat because she didn't want the cat scratching the kids. But she was not allowed that deduction. Dogs and cats are considered too personal. However, fish, gerbils, mice, snakes, chickens, ducks, farm animals, if you are incorporating those animals into your curriculum, you're teaching kids about fish and gerbils and pigs and goats and so on, then yes, you could incorporate expenses associated with those animals, but you got to make the connection that here's why this is part of my curriculum and here's how children are learning. Dogs and cats, just no.
What about gardening expenses? Is that the same as lawn?
Yeah, gardening expenses, you have to have a safe outdoor place for kids to play. You can't have, just weeds all over the place. So expenses associated with maintaining the garden or the lawn, yes. Now, if you have a rose garden in the back 40 of your house that the kids don't have anything to do with because those are your prize roses, then no. But if it's a flower garden or a vegetable garden, and it's part of the environment that children are in, or you're teaching children about vegetables or plants and flowers, then yes. And if you're paying somebody to mow the lawn or paying somebody to spread fertilizer and so on, maintain your yard, yes, you can claim part of that cost.
Here's a specific, this is more about a couple questions about getting the spreadsheets, and I wanted to let people know that there's an online business tutorial on WICA's website that's got a ton of information, and I'll send the link in the second follow-up email as well. I think you answered this. Should a provider have separate policy, handbook, and contract, or should they be together?
Separate, in my opinion.
Yeah.
It's not a requirement. That's my opinion.
And don't you think it's bad business practice to have different rules for different parents?
No, you have different rules for infants and toddlers. You charge different amounts for that. You should assume that parents will know what the rules are for the other parents. So if you're treating parents differently, you should assume everybody's going to know about it. But is it reasonable to raise your rates for the new families and keep them the same for the old families? I think that's reasonable. Is it reasonable to have different pickup times to meet your schedule? Yes. If one parent says, I got a staff meeting at 5:30 every night or every Wednesday, and it's going to be really, really hard for me to be there at 6, and I don't want to have to pay $1 a minute late fee every day because of my schedule, could you say to that parent, okay, for you, Wednesday pickup time is 6:15, and then there's $1 a minute. For everybody else, it's 6 because they get off work earlier. That's a reasonable rule that gives parents different options because of their schedules. So, yeah, I think to say I'm going to charge more because you work at Walmart or because you drive a foreign car, no, I think that's crazy. But there are many ways in which different circumstances, different parents, my mother's in the hospital, I can't pay you this week, okay, fine. I can't do something else. I can't bring an extra change of clothes because we just had a fire and I don't have any more clothes. Okay, fine. You bend your rules all the time. Everybody's going to know about it. As long as you're acting reasonably, I don't think this is a problem.
Do you think it's more important to pay off the house first versus setting aside in an IRA?
IRA. Why? You're able to deduct a portion of your mortgage interest, and your house is not appreciating at as fast as you can earn money in a stock market. So because you're able to deduct the mortgage interest, I would strongly recommend putting money in retirement. Why else? If you paid, let's say you put all your money into paying off your house. So now you're getting ready to retire and you have a totally paid off house. Some emergency comes up or some other financial need comes up. To take the money out of the house, you'd either have to sell a house or take out a mortgage, and that's not simple. And there are costs, high costs associated with taking out mortgages on your house. Whereas if you put money into an IRA, and then it's earning money tax-free, and then later, now when you're ready to retire, you can take money out of the IRA. And you can take all of it out. You can take some of it out. Much more control over the money. Don't pay off the house and sacrifice your retirement.
Can you deduct restaurant meals if you're having a business-related meeting?
A business meal is a meal eaten outside of your house. If the meal is eaten when you're staying overnight somewhere, you're going to Green Bay for the conference and you're staying there overnight, you can claim the meals that you eat during that conference. If you are not staying somewhere overnight and you're going out with somebody to have a meal, you can deduct that meal only under these circumstances. The purpose of the meal has to be business. You're not going out with your husband to say, how was this week? You're not going out with a friend saying, how's it going? Let's go out to dinner. No, you'd have to say, it's another provider, it's a parent, and you're saying, let's go out to dinner, let's talk about your child biting, let's talk about our curriculum, let's talk about something related to the business. How do you handle this issue with parents? You would need to keep, obviously, a receipt for the food. You would need to write down who the person you had the meal with was, and you'd have to write down what you talked about so we can show that that was a business meal. And in that circumstance, if you do all that, then you could deduct half of the cost of the food. If your husband is actively involved with your business, having business meal with your husband once or twice a month, yeah. Your husband's not really actively involved. He's not caring for the kids, or he's not really doing a lot directly with your business. Once or twice a year, maybe, but not every week.
Okay, so different topic here. If a provider does not live in the home, she does care in, but does bookwork, lessons plans, etc. at her home, can she still claim these hours? It's a family provider that has another home.
Yeah, no. If you're doing childcare in a home you don't live in, and assuming in that other home you're only doing childcare, you can deduct 100% of all the expenses in that home. And you don't even need to keep track of the hours you work because everything is 100%. If you are doing some paperwork, record keeping, whatever, in the home you live in, you can't claim expenses for that home you live in because your place of business is the other home. You could claim the cost of the things you own in the home you live in that you're using for your business. The desk, the folders, the file cabinet, the computer, the printer, whatever items in your home, you can deduct some or all of those, but not the property tax, mortgage interest, etc. of the house itself, because you can only deduct that for the house where your business is located.
Great. There's one more, it's kind of a catch-22 when you want the bottom line on taxes so you don't have to pay, but then it shows no payments so you have Social Security.
Correct. If you're doing childcare particularly for a long period of time, you're taking advantage of all the record-keeping rules and everything I'm saying about deducting, and as a result, your profit is smaller, and as a result, you're paying in less in Social Security tax, and as a result, over a long period of time, if you do this, you're going to get less in benefits from Social Security. So that's a dilemma. You're right. What's the solution to that? The solution, in my opinion, is not to not claim some expenses, to show a higher profit, to pay more in taxes, to get more in Social Security benefits. No. I think you're much better off making a greater effort to save money for your own IRA. Okay, your Social Security may not be large, but this makes it even more incumbent to save money for retirement and to reduce other expenses, other personal expenses. Don't eat out so much. Don't buy as much stuff, and make the handout pay yourself first. Go back to that one, and put money aside for yourself to augment your Social Security. I think if you tried to reduce your profit, increase your profit, the tax loss, you're paying more in taxes, and I don't think that's going to be a corresponding benefit for Social Security. You're better off saving.
And I think most of us have heard of an IRA, but what is a MYRA?
A MYRA is a form of a Roth IRA. A Roth IRA, unlike all other IRAs, you don't get a tax deduction when you put money into a Roth IRA. When you put money into it, it earns interest. When you take money out of a Roth IRA, you don't pay tax on what you put in, and you don't pay tax on the interest. With every other IRA, when you contribute to it, you get a tax deduction right away. But when you take the money out later, you're going to pay tax on what you put in, and you're going to pay tax on the interest. A MYRA is a form of a Roth IRA. It's set up through direct deposit with the government. It's a direct government program. So you would say, all right, you contact the IRS and say, okay, I'm going to start with 25 bucks. I'm going to put in 10 bucks a month or whatever you want. And you don't get a tax deduction, just like a Roth IRA. It earns interest tax-free. You take it out. You're not going to pay tax on it. And it's taken out of your checking account or savings account, like 10 bucks a month, 20 bucks a month, whatever you want. So you don't have to worry about it, just automatic direct deposit from your bank account. So it has the features of a Roth IRA.
Myra. How much can I pay my helper without a receipt?
Well, if let's see, if we're talking about a non-family member and somebody's helping you care for kids, that person's an employee, and you must treat them as an employee, withhold Social Security tax, pay federal and Wisconsin unemployment tax, get workers' compensation insurance, and file a series of forms. The only time such a person would not be an employee is if either they worked for an agency and you hired the agency, or they were in the business of providing substitute care. They had their own business, Sally's Substitute Service, and that she worked for other providers. Otherwise, no matter how few hours they work for you, that person is an employee, and you need to keep all those records.
And what about a family member helper?
So if it's a family member who's age 18 or older, you have to withhold Social Security tax. If the family member is under age 18, they can earn no Social Security tax, no federal or state unemployment tax. So there is tax savings to hire your 17, 16, 15, 14, 13-year-old, etc. If that child earns less than, and last year the number was $6,300, I forget what it is this year. So if they earn less than that, they don't even have to pay any income tax. So in order to make that work, you've got to keep the records to show that the person did work for your business, your child. You know, cleaned up after the kids, they set the table, what did they do, and a job description, and show records that you paid the child. It can be cash, but if you're keeping records to show all this, then they're not paying any taxes, and you can deduct it all. I've written about this on my blog under this heading Record Keeping. If you look under there, there's a section that says Employees, and there's a bunch of articles that talk about hiring family members.
And then there are a number of questions about subsidy and W-2, which I think are better answered by Youngstar or Wisconsin staff person. So I will compile those and see if we can get that information to everybody.
Fine.
And so I think that's, again, there's a lot of questions about the food program that I think we should consolidate. So in the interest of time, the only last thing is Kelly clarified that page 46 of the 2016 evaluation criteria, so the Youngstar evaluation criteria, contains information about the IRS and maintaining records. So I'll send that link to you as well. So Tom, thank you. Let's wrap this up for the night. Appreciate it very much you staying on, and thanks in advance for answering the questions that we send by email.
Great. Thanks, everyone. Good night.
Thank you.